Let us start the book. The Psychology of Money. Let me tell you about two men. The first was named Ronald Reed. He was a janitor and a gas station attendant from rural Vermont. He fixed cars at a gas station for 25 years and swept floors at a JCPenney for 17 years. He bought a small two-bedroom house for $12,000 at age 38 and lived there for the rest of his life. His friends said his main hobby was chopping firewood. Every outward appearance, Ronald Reed was an ordinary, low-key, unremarkable man. He died in 2014, at the age of 92. And that is when this humble janitor made international headlines. Because Ronald Reed, the gas station attendant, left behind a fortune of more than $8 million. He gave $2 million to his stuck kids and donated more than $6 million to his local hospital and library. Out of the nearly 3 million Americans who died that year, fewer than 4,000 had a net worth over $8 million. One of them was a janitor. How did he do it? There was no secret. No lottery ticket. No inheritance. Ronald Reed simply saved what little he could, invested it in solid blue-chip stocks, and then waited. For decades. And his tiny savings compounded into more than $8 million. Now meet the second man. His name was Richard Fuscone, and he was everything Ronald Reed was not. Harvard-educated, an MBA. A high-flying Merrill Lynch executive so successful that he retired in his 40s to become a philanthropist. A business magazine put him on its 40 under 40 list of the most successful business people in America. In the mid-2000s, Fuscone borrowed heavily to expand an 18,000-square-foot mansion in Connecticut, a home with 11 bathrooms, to elevators, to pools, 7 garages, and monthly upkeep of more than $90,000. Then the 2008 financial crisis hit, and it turned his finances to dust. Buried in debt, he went bankrupt. His homes were foreclosed. And just 5 months before the janitor Ronald Reed left his fortune to charity, Richard Fuscone's mansion was sold at auction for 75% less than what it was once thought to be worth. Stop and think about how strange that is. In what other field could this possibly happen? There will never be a story about a janitor performing heart surgery better than a Harvard-trained surgeon. There is no story of a gas station attendant designing a better skyscraper than the world's top architects. But in the world of money, these stories happen. A man with no education, no training, and no connections massively outperformed a man with the best education, the best training, and the best connections. Because, as Morgan Housel argues in this brilliant book, doing well with money has very little to do with how smart you are and everything to do with how you behave. Financial success is not a hard science. It is a soft skill, where how you act matters far more than what you know. Ronald Reed was patient. Richard Fuscone was greedy. And that one difference in behavior was enough to erase a lifetime gap in education and experience. That soft skill is what Housel calls the psychology of money. And over the next hour or so, I am going to walk you through the entire book, 20 short chapters distilled into the most powerful lessons about wealth, greed, and happiness you will ever hear. This is not a book about what to do with your money. It is a book about what happens in your head when you try. So get comfortable, and let us get started. What you will learn. Before we dive into the key points, here is a quick picture of what you will take away from this video by the end. First, you will learn why nobody is actually crazy with money, and why every person's financial decisions make perfect sense once you understand the unique life experiences that shape them. Second, you will understand the enormous, invisible role that luck and risk play in every financial outcome and why nothing is ever as good or as bad as it seems. Third, you will discover why the hardest financial skill in the world is getting the goalpost to stop moving, and why some of the richest people on earth destroyed their lives because they never learned the meaning of the word enough. Fourth, you will see why compounding is the single most powerful force in finance, and why Warren Buffett's real secret has nothing to do with picking great stocks. Fifth, you will learn why getting wealthy and staying wealthy are two completely different skills, and why survival is the only strategy that truly matters. Sixth, you will understand how tail events drive almost everything, and why you can be wrong half the time and still make a fortune. Seventh, you will discover the highest form of wealth, which is not a number in your bank account at all. It is the ability to wake up every morning and say, I can do whatever I want today. Eighth, you will learn why no one is as impressed with your possessions as you are, and why real wealth is the money you do not see. Ninth, you will see why your savings rate matters more than your income or your investment returns, and why saving does not need a reason. 10th, you will learn why being reasonable with money beats being coldly rational, why history is a misleading guide to the future, and why room for error is the most underrated force in finance. And finally, you will understand why your future self will want different things than you think, why volatility is a fee, not a fine, why pessimism always sounds smarter than optimism, and how to put every one of these lessons together into a simple plan for your own life. That is the road ahead. Now let us get into the first key point. Point 1. No one is crazy with money. The first big idea in this book might make you feel a lot better about your own financial decisions and a lot less judgmental about everyone else's. Here it is. People do some crazy things with money, but no one is actually crazy. Think about how differently we all come to this topic. People from different generations, raised by different parents, earning different incomes, in different countries, born into booming economies or collapsing ones, all learn very different lessons about money. The person who grew up in poverty thinks about risk and reward in ways the child of a wealthy banker cannot begin to imagine. The person who came of age during high inflation experienced something the person raised during stable prices never felt. Your personal experiences with money make up maybe 0.00000000001% of everything that has happened in the world, but they make up maybe 80% of how you think the world works. House points to a fascinating study by two economists who dug through 50 years of data on what Americans actually do with their money. They found that people's lifetime investing decisions are overwhelmingly anchored to what the economy was doing when they were young adults. If you grew up while inflation was high, you invested less in bonds for the rest of your life. If you grew up while the stock market was strong, you invested more in stocks for the rest of your life. It was not intelligence or education driving these choices. It was the dumb luck of when and where you were born. Even the legendary bond investor Bill Gross admitted he probably would not be who he is if he would have been born a decade earlier or later, because his entire career happened to line up with a generational collapse in interest rates that sent bond prices soaring. To Gross, bonds were wealth-generating machines. To his father's generation, who lived through brutal inflation, they looked like wealth incinerators. Same investment. Different lives. Completely different views. Now take what looks like the craziest money behavior of all, lottery tickets. Americans spend more on lottery tickets than on movies, video games, music, sports tickets, and books combined. And the people who buy the most are the poorest households, spending around $400 a year on tickets, while 40% of Americans say they could not come up with $400 in an emergency. That sounds insane. But strain a little, and you can imagine the reasoning. If you live paycheck to paycheck, and saving feels impossible, and the nice vacations and safe neighborhoods and college funds that other people take for granted feel permanently out of reach, then buying a lottery ticket might be the only moment in your life when you can hold a tangible dream in your hand. You are not buying a ticket. You are paying for a dream. You do not have to agree with that reasoning, and it is still a bad financial move, but you can understand it. And that phrase, "what you are doing seems crazy, but I kind of understand why you are doing it," sits at the root of almost all our money decisions. There is one more piece to this. Money decisions feel like they should be ancient wisdom, but the modern financial world is shockingly new. The 401k, the backbone of American retirement, did not exist until 1978. The Roth IRA was not born until 1998. If it were a person, it would barely be old enough to drink. Index funds are less than 50 years old. Before World War II, most Americans simply worked until they died. So when we struggle with saving and investing, we are not crazy. We are all just newbies, learning a game humanity has only been playing for a few decades. Everyone is making decisions based on their own unique experiences that seem to make sense to them in the moment. That is the first lesson. A little more humility about your own views, and a little more compassion for everyone else's. Point 2. Respect the power of luck and risk. The second big idea is one of the most uncomfortable truths in all of finance. Luck and risk are siblings. They are both the reality that every outcome in your life is guided by forces other than your individual effort. You cannot believe in one without equally respecting the other. To show this, Housel tells the story of how Bill Gates got rich. Ace was brilliant and obsessively hardworking, no question. But he also attended Lakeside School near Seattle, which in 1968 became one of the only high schools on the entire planet to have a computer. A forward-thinking teacher convinced the school's Mothers Club to use $3,000 from a rummage sale to lease a computer terminal at a time when most university graduate programs did not have anything close to it. 13-year-old Bill Gates fell in love with that machine, and along with his classmate Paul Allen, he spent nights and weekends becoming a computing expert years before almost anyone else on Earth could. Now run the numbers. In 1968, there were roughly 303 million high school-age people in the world. Only about 300 of them attended Lakeside School. That means Bill Gates had literally 1 in a million luck just by going to that school. And to his credit, Gates has never denied it. He told Lakeside's graduating class, if there had been no Lakeside, there would have been no Microsoft. But here is the part of the story almost no one knows. There was a third member of that computer gang, a boy named Kent Evans. He was Bill Gates' best friend, and by Gates' own account, the best student in the class. He was just as skilled with computers, and unlike Paul Allen, he shared Bill's burning business ambition. The two of them schemed endlessly about the future, certain they would build something big together. Gates says Kent could easily have been a founding partner of Microsoft. But it never happened because Kent Evans died in a mountaineering accident before he even graduated from high school. The odds of dying on a mountain in high school are roughly 1 in a million. So Bill Gates experienced 1 in a million luck. Kent Evans experienced 1 in a million risk. The same force, the same magnitude, just pointed in opposite directions. This is why Housel says that when judging financial success, both your own and other people's, nothing is ever as good or as bad as it seems. When the Nobel Prize-winning economist Robert Shiller was asked what he most wanted to know about investing that we cannot know, he answered, the exact role of luck in successful outcomes. Everyone knows luck plays a role. But it is rude to suggest someone's success came from luck, and it is demoralizing to admit your own success might have, so we quietly ignore it. The same goes for failure. If you buy a stock and it goes nowhere for 5 years, did you make a bad decision, or did you make a good decision with an 80% chance of success and simply land in the unlucky 20%? It is nearly impossible to know. House pushes this further with the story of Cornelius Vanderbilt, the railroad tycoon. After closing a series of business deals, one of his advisors leaned in and warned him that every transaction he had just agreed to broke the law. Vanderbilt famously scoffed, asking whether anyone really thought you could run a railroad while following the statutes of New York. And here's the trap. Because Vanderbilt succeeded, history remembers his law-breaking as bold, visionary swagger. But imagine the exact same behavior with a slightly different outcome: a court order, a collapse, a prison sentence, and the same man becomes a cautionary tale of recklessness. We praise Vanderbilt for flaunting the rules with the same passion that we condemn Enra for doing the same thing. The behavior was identical. Only the outcome differed, and the outcome was soaked in luck. John D. Rockefeller's story reads the same way. A judge once called his company no better than a common thief, yet historians often describe his rule-bending as cunning genius. The line between inspired visionary and criminal can be a coin flip. Even Benjamin Graham, the father of value investing and Warren Buffett's mentor, made the majority of his fortune from one enormous position in GICO stock that, by his own admission, broke nearly every diversification rule he himself taught in his famous books. The greatest teacher of investing rules got rich by breaking them. That is how slippery luck and risk really are. So what do you actually do with this lesson? 2 things. First, be careful who you praise and admire, and be careful who you look down on. The line between bold and reckless is often only visible in hindsight. And second, when you study success, focus less on specific individuals and more on broad patterns. Trying to copy Warren Buffett is dangerous because his results are so extreme that luck almost certainly played a huge role, and you cannot copy luck. But broad patterns, like the fact that people who control their own time tend to be happier, show up so often that they are far more likely to apply to your life. Less idol worship. More pattern recognition. And a healthy respect for the role of chance in everything. Point 3. The hardest skill is knowing when you have enough. The third key point asks a haunting question. Why would someone who has hundreds of millions of dollars risk everything for money they do not need? The answer reveals the hardest financial skill in the world: getting the goalpost to stop moving. Consider Rajat Gupta. He was born in Kolkata and orphaned as a teenager. From those beginnings, he rose to become the CEO of McKinsey, the most prestigious consulting firm on earth. By the time he retired, he was worth around $100 million. He worked on philanthropy with Bill Gates. He sat on the boards of 5 public companies. By any sane measure, he had won the game of life. But Gupta did not want to be a mere 100 millionaire. By all accounts, he wanted to be a billionaire, and he wanted it badly. As a board member at Goldman Sachs, he learned in 2008 that Warren Buffett was about to invest $5 billion to save the bank during the financial crisis. 16 seconds after learning this confidential information, Gupta called a hedge fund manager and tipped him off. It was blatant insider trading. He threw away his fortune, his freedom, and his reputation, and he went to prison. Or consider Bernie Madoff, the most notorious Ponzi schemer in history. What most people forget is that before his fraud, Madoff ran a completely legitimate and wildly successful business. His market-making firm made him between $25 and $50 million a year, legally. He was already rich beyond imagination. And yet, the fraud. The question for both men is the same. They had everything, so why risk it all for more? Housel's answer is that they had no sense of enough. And he offers several hard-won lessons about it. First, the hardest financial skill is getting the goalpost to stop moving. If your expectations rise every time you achieve more, then there is no logic in striving for more, because you will feel exactly the same after getting it. It is like climbing a mountain whose peak rises faster than you can climb. Second, the engine driving all of this is social comparison. Think of a rookie baseball player earning $500,000 a year. He is rich by any standard. But he compares himself to the star earning $30 million. And that star compares himself to a hedge fund manager earning $300 million. And that hedge fund manager compares himself to the top 5 managers who earn even more. The ceiling of social comparison is so high that virtually no one ever reaches it. It is a battle that can never be won. The only way to win is to refuse to fight it, to accept that you might have enough, even if it is less than those around you. Third, and this is important, enough is not too little. The idea of having enough might sound like settling, like leaving opportunity on the table. But Housel says enough is realizing the opposite, that an insatiable appetite for more will eventually push you to the point of regret. And fourth, there are many things that are never worth risking, no matter the potential gain. Your reputation is invaluable. Your freedom is invaluable. Your family and friends are invaluable. Your happiness is invaluable. The smartest move with all of them is knowing when you have enough, so you never do anything that puts them on the line. Warren Buffett put it perfectly when describing the Madoff types of the world. To make money they did not have and did not need, they risked what they did have and did need. And that is just plain foolish. If you risk something important to you for something unimportant to you, it makes no sense at all. Point 4. Compounding is the 8th wonder of the world. The fourth key point is about the most powerful force on all finance, a force so counterintuitive that even the smartest people consistently underestimate it. That force is compounding. House opens this chapter with the story from a completely different field, the billion-year history of ice ages, because it teaches the deepest truth about growing money. For a long time, scientists were baffled by what could possibly cause the Earth to freeze over and thaw again, not once but 5 separate times. The force required seemed unimaginably huge, so the theories were equally grand. Rising mountain ranges shifting the winds, or massive volcanic eruptions. None of them could explain the repeating cycle. Then a Serbian scientist named Milutin Milankovic found the real answer, and it shocked everyone with its smallness. Tiny wobbles in the Earth's tilt and orbit meant that some summers were just slightly cooler than usual. That is all. A cool summer meant a little snow from the previous winter did not fully melt. That leftover snow reflected more sunlight, which made the next summer cooler, which left more snow, which reflected more light. Within a few tens of thousands of years, a bit of unmelted snow had compounded into an ice sheet covering continents. As one climate scientist put it, it is not the amount of snow that causes ice sheets, but the fact that snow, however little, lasts. The big takeaway is that you do not need tremendous force to create tremendous results. If something compounds, if a little growth fuels future growth, a tiny starting base can produce outcomes so extraordinary they seem to defy logic. And now apply that to the most famous investor on earth. As Housel wrote this book, Warren Buffett's net worth was $84.5 billion. Here is the staggering detail buried in that number. 84.2 billion of it was accumulated after his 50th birthday. 81.5 billion came after he qualified for Social Security in his mid-60s. Read that again. More than 96% of Warren Buffett's wealth came after an age when most people retire. Yes, Buffett is a phenomenal investor. If you attribute all his success to investing genius, you miss the real key. The real key is that he has been a phenomenal investor for 3/4 of a century. He started seriously investing when he was 10 years old. House runs a thought experiment to prove the point. Imagine Buffett had been a more normal person, spending his teens and 20s exploring the world, and only started investing at age 30 with $25,000. And imagine he retired at 60 to play golf. If he had earned his same incredible annual returns over just that 30-year window, his net worth today would not be $84 billion. It would be $11.9 million. That is 99.9% less than his actual fortune. Effectively, all of Warren Buffett's financial success can be tied not to his skill alone, but to the base he built as a teenager and the longevity he maintained into old age. His real superpower is not stock picking. It is time. Here is another way to see it. Jim Simons, the head of the hedge fund Renaissance Technologies, has compounded money at 66% annually since 1988, a record nobody else comes close to. Buffett has compounded at roughly 22%, just a third as much. Yet Simons' net worth is $21 billion, which is 75% less than Buffett's. Because Simons did not hit his investing stride until he was 50. He has had less than half as many years to compound. If Buffett's secret was returns, Simons would be far richer. Buffett's secret is duration. The problem is that compounding never feels intuitive. Our brains think in straight lines, not exponential curves. If I ask you to add 8 plus 8 plus 8 plus 8 in your head, you will get 40 in a few seconds. If I ask you to multiply 8 by 8 by 8 by 8 by 8, your head explodes. The danger is that because compounding is not intuitive, we ignore its potential and try to solve our money problems through other means, like chasing the highest returns or hunting for the next hot stock. Huge returns grab headlines, but they tend to be one-off events that cannot be repeated. Good investing is not necessarily about earning the highest returns. It is about earning pretty good returns that you can stick with for the longest possible period of time. That is when compounding runs wild. House points out that more than 2,000 books have been written dissecting how Warren Buffett built his fortune, analyzing his stock picks, his strategies, his philosophies. But not one of them carries the title that actually explains the majority of his success. This guy has been investing consistently for 3/4 of a century. It is just hard to wrap your head around that math because it is not intuitive. There are endless books on economic cycles, trading systems, and sector bets. But as Housel memorably puts it, the most powerful and important finance book ever written should be called Shut Up and Wait, and it would be just one page, with a single long-term chart of economic growth. Time is the most powerful force in investing. It makes little things grow big and big mistakes fade away. You cannot buy it, borrow it, or fake it. You can only start early and refuse to interrupt it unnecessarily. Point 5. Getting wealthy and staying wealthy are two different skills. The fifth key point is one of the most original ideas in the book. There are a million ways to get wealthy. But there is only one way to stay wealthy. Some combination of frugality and paranoia. Getting money and keeping money are two completely different skills. Alice tells the story of two men whose lives collided around the Great Depression. Jesse Livermore was the greatest stock trader of his day. By age 30, he was worth the equivalent of $100 million in today's money. When the market crashed in October 1929, the most devastating week in Wall Street history, his wife feared the worst. Reports of ruined speculators taking their own lives were spreading through New York. But when Jesse walked through the door, he announced the unthinkable. He had been short the market, betting stocks would fall. In the worst month in stock market history, Jesse Livermore made the equivalent of more than $3 billion in a single day, becoming one of the richest men in the world. At that very same moment, a real estate developer named Abraham Germansky, who had bet everything on rising stocks, wandered the streets of New York in ruin and disappeared. The crash that destroyed Germansky made Livermore unimaginably rich. But fast forward 4 years, and the stories cross again. Riding high on his success, Livermore kept making bigger and bigger bets, with more and more borrowed money. He eventually lost everything, and tragically, he too ended his own life. The lesson cuts deep. Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite. It requires humility and a healthy fear that what you have made can be taken away just as fast. It requires accepting that at least some of what you have earned was luck, so past success cannot be counted on to repeat forever. House illustrates the alternative with the story of Rick Guerin. You have heard of Warren Buffett and Charlie Munger, but 40 years ago there was a third member of their group. Rick Guerin was a brilliant investor who made deals right alongside them. But Rick was in a hurry. He leveraged his investments with borrowed money, and when the market crashed in the mid-1970s, he got margin calls and was forced to sell his Berkshire stock to Buffett at a deep loss. Buffett and Munger were not in a hurry. And as Buffett later said, that is the difference. Charlie and Warren knew they would get rich, and they were not in a rush. Survival kept them in the game for the decades that compounding requires. This is why Housel says the single most important financial skill is simply survival. Not growth, not brains, not vision. Just the ability to stick around for a long time without wiping out. Because compounding only works if you give an asset years and years to grow, and one catastrophic loss can erase a lifetime of gains. He describes his own approach with 3 ideas. First, more than big returns, he wants to be financially unbreakable, because if he is unbreakable, he can stay in the game long enough for compounding to work its magic. Second, planning is important, but the most important part of every plan is to plan on the plan not going according to plan. And third, he aims for what he calls a barbelled personality, optimistic about the future, but paranoid about what will prevent him from getting to the future. You need short-term paranoia to keep you alive long enough to enjoy long-term optimism. Consider this. In the 170 years covered in the book, America's standard of living rose 20-fold. But in that same stretch, there were dozens of recessions, financial panics, wars, and crashes. Stocks lost a third of their value at least 12 times. The optimists who survived all of that got rich. The ones who got wiped out along the way, no matter how brilliant, never got to see it. Point 6. Tails drive everything. You can be wrong half the time and still win. The sixth key point will completely change how you think about success and failure. In finance, and in much of life, a tiny number of events drive the overwhelming majority of results. These rare, extreme outcomes are called tail events. And once you understand them, you realize you can be wrong half the time and still make a fortune. House opens with the story of Heinz Berg-Gruen, a man who fled Nazi Germany in 1936 and showed little promise in his youth. Yet by the 1990s, he had become one of the most successful art dealers of all time, with a collection of Picassos and Matisse worth well over $1 billion. Was he a genius with a magical eye for art? Maybe. But there is a more honest explanation. The great art dealers bought everything they could get their hands on. They bought in massive portfolios, not individual pieces they happened to like. And then they sat and waited for a few winners to emerge. Perhaps 99% of what Berg-Gruen acquired turned out to be of little value. But it did not matter, because the other 1% turned out to be works by artists like Picasso. He could be wrong most of the time and still end up stupendously right. This is exactly how markets work. A huge chunk of the stock market's entire long-term return comes from a small handful of monster winners, while a large share of public companies end up being effectively worthless over time. In 2018, Amazon alone drove 6% of the entire S&P 500's returns. And within companies, the same rule applies again. Amazon's success is overwhelmingly due to Prime and web services, to tail events inside a company that experimented with hundreds of products, including famous flops like the Fire Phone. Apple's success is driven overwhelmingly by the iPhone. The tails of the tails drive everything. Perhaps the most vivid example of all is Walt Disney. Steamboat Willie made him famous as an animator, but as a businessman, he was struggling badly. His first studio went bankrupt. His films were monstrously expensive and financed on terrible terms. By the mid-1930s, Disney had produced more than 400 cartoons. Most of them were short, most were loved by audiences, and most of them lost a fortune. Then came Snow White and the Seven Dwarfs. The $8 million it earned in the first 6 months of 1938 was an order of magnitude beyond anything the company had ever made. It paid off all of the studio's debts, funded retention bonuses for key employees, and bought the state-of-the-art Burbank studio where Disney still operates today. By 1938, Walt had produced several hundred hours of film. But in business terms, the 83 minutes of Snow White were all that mattered. One tail event redeemed 400 money losers. And here is where it gets personal, because this rule applies to your behavior too. Consider what Napoleon said about military genius: the man who can do the average thing when everyone else around him is losing his mind. Most of investing is utterly ordinary, days and months where nothing you do really matters. But a small number of days, the days of panic, crashes, and euphoria, are where your entire lifetime of results gets decided. How you behave during a handful of terrifying market crashes likely matters more than every other decision you have made combined. The investor who held on calmly through the 2008 crisis did better than the brilliant analyst who panicked and sold at the bottom. Even the greatest performers fail constantly. Warren Buffett has said he has owned hundreds of stocks in his life, and the vast majority did very little. His fortune was made by a small handful of enormous winners. The venture capital industry is built entirely on this math. One firm crunched the numbers on more than 21,000 startup financings across a decade and found that 65% lost money, while only about 1% produced returns of more than 20 times the investment. That 1% pays for everything else. So when you see someone successful, remember that you are seeing their tail events, the highlight reel, while their hundreds of quiet failures stay invisible. The takeaway is liberating. It is okay to fail. It is okay for a lot of things not to work. What matters is that you stay in the game and never miss the few moments that change everything. Point 7. Freedom is the highest dividend money pays. We can now arrive at what may be the most important point in the entire book, the one Housel himself calls the highest form of wealth. And it has nothing to do with cars, houses, or status. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. People want to be richer because they believe it will make them happier. But happiness is complicated, and everyone is different. If there is a single common denominator in happiness, a universal fuel of joy, it is this: people want to control their lives. The ability to do what you want, when you want, with the people you want, for as long as you want, is priceless. It is, in Housel's phrase, the highest dividend money pays. The evidence for this goes back decades. A psychologist named Angus Campbell at the University of Michigan studied what actually made people happy at a time when psychology focused mostly on what made people miserable. What he found cut across every category. You could not predict happiness by income, geography, or education because plenty of people in every group were miserable. The most powerful common trait of happy people was something else entirely: a strong sense of control over their own lives. Control over your time and your choices beats salary. It beats the size of your house. It beats almost anything. And this is precisely where modern life has played a trick on us. Compared to past generations, we are far richer, but our control over our time has actually shrunk. A factory worker in 1950 left his job at the gate when the whistle blew. Today, so many of us work in jobs where the tool of our trade is our own mind, which means the workday never really ends. We answer emails at dinner, take calls on vacation, and think about projects at midnight. House makes the point with John D. Rockefeller himself, one of the most successful businessmen of all time. Rockefeller was famously a recluse who spent most of his day in quiet thought. His job was not drilling wells or hauling barrels. His job was thinking, making good decisions, and his product was not something you could see or hold. That is what most modern knowledge work looks like now, and it means our work follows us everywhere, living in our heads long after we leave the office. We are richer than ever, yet many of us do not feel much happier because money without control over your time is not really freedom at all. House learned this lesson personally. He once chased a prestigious investment banking career because of the money and the status. But the job demanded total control over his life, and he quit after a month because even work you enjoy can feel like torture on a schedule you cannot control. Doing something you love on a timeline you cannot control feels exactly the same as doing something you hate. There is a beautiful confirmation of this idea from the other end of life. A gerontologist named Carl Pilmer interviewed 1,000 elderly Americans, looking for the most important lessons they had learned across long lives. And here is the remarkable thing. Not one of them, not a single person out of 1,000, said that to be happy you should work as hard as you can to buy things you want. Not one said it is important to be at least as wealthy as the people around you. What they did say was to cherish friendships, to be part of something bigger than yourself, and to spend quality, unstructured time with their children. The people with the most experience of life never mentioned the nice car or the big house. They valued time, relationships, and freedom. So when you are deciding what to do with your money, remember what it is actually for. Money's greatest intrinsic value is its ability to give you control over your time. Every dollar you save is a piece of your future that you own, instead of someone else owning it. Point 8. No one is impressed with your stuff. Real wealth is what you do not see. The eighth key point combines two of the book's most memorable chapters into one powerful idea about wealth and status. It starts with what Housel calls the man in the car paradox. When Housel worked as a valet at a fancy Los Angeles hotel, he used to daydream as drivers rolled up in their Ferraris and Lamborghinis. And here's what he noticed about his own daydream. When he saw someone in a great car, he never once thought, wow, the guy driving that car is cool. Instead, he thought, wow, if I had that car, people would think I am cool. You see the irony? He was a person admiring the car while completely ignoring the driver. And everyone does this. People buy impressive things because they want admiration and respect. But the people looking at your car are not admiring you. They are imagining themselves in your seat. No one is as impressed with your possessions as you are. If your goal is respect and admiration, buying expensive things will never get it for you. You are far more likely to gain respect through kindness and humility than through horsepower and chrome. That leads directly into one of the most important sentences in the entire book. Wealth is what you do not see. During his valet years, Housel assumed everyone driving a luxury car was rich. But as he got to know them, he realized many were ordinary earners who poured a huge slice of their paycheck into a car. Here is the trap our brains fall into. When we see someone driving a $100,000 car, the only hard data point we have is that they have $100,000 less than they did before they bought it, or $100,000 more in debt. We know nothing about their actual wealth. The singer Rihanna nearly went bankrupt from overspending and sued her financial advisor. The advisor's response was unforgettable. Was it really necessary to tell her that if you spend money on things, you will end up with the things and not the money? So what is wealth, really? Wealth is the nice car not purchased, the diamonds not bought, the watches not worn, the clothes foregone, the first-class upgrade declined. Wealth is financial assets that have not yet been converted into the visible stuff. And that is exactly why wealth is so hard to learn by observation. We have rich role models everywhere, people with big incomes and big spending, because spending is visible. But true wealth is hidden by definition. The millionaire next door might be a janitor like Ronald Reed, and the flashy spender in the mansion might be one bad year away from bankruptcy, like Richard Fuscone. House draws the distinction sharply. Being rich is about your current income, and you can see it everywhere. Being wealthy is about what you have saved and invested, the options and freedom you have accumulated. It is invisible. And the world is filled with people who look modest, but are actually wealthy, and people who look rich but live on the razor's edge of solvency. When you judge success by what you can see, you are learning from exactly the wrong teachers. Point 9. Just save money, you do not need a reason. The ninth key point is the simplest, and maybe the most practical lesson in the whole book. House says, let me convince you to save money. It will not take long. Because building wealth has surprisingly little to do with your income or your investment returns, and almost everything to do with your savings rate. Think about it through a simple comparison. Investment returns can make you rich, but they are always shrouded in doubt. Strategies go in and out of style, markets crash, and so much depends on luck. Personal savings and frugality are the only parts of the money equation that are completely, 100% in your control. A person who saves a meaningful chunk of modest income will, over time, almost always end up wealthier than a high earner who saves nothing. Wealth, remember, is just the accumulated leftovers after you spend what you take in. And you can build those leftovers without a high income, but you have no chance of building them without a high savings rate. It is clear which one matters more. Here is the deeper insight, though. Past a certain level of income, your savings rate is not really determined by your salary. It is determined by your ego. Everyone needs the basics. Once the basics are covered, there is a level of comfort. But beyond comfort, so much of modern spending is simply ego translated into objects, spending money to show people that you have money. So Hauser's one of the most quietly radical definitions in the book. Savings is the gap between your ego and your income. People with enduring personal finance success, not necessarily high incomes, tend to share a trait. They simply do not care what other people think of them. When you can stop performing wealth for an audience that is not even paying attention, your savings rate soars, and real wealth begins to grow in the background. And here is the part that changes how you think about saving forever. You do not need a specific reason to save. Sure, it is great to save for a car, a house, or retirement. But saving does not require a goal at all. You can save just for saving's sake. In fact, you should, because life is an endless chain of surprises that no spreadsheet can predict. Savings that are not earmarked for anything in particular are a hedge against life's inevitable ability to shock you at the worst possible moment. Best of all, savings buy you something no salary can: flexibility and control over your time. Every dollar saved is like owning a piece of your future. Savings mean you can wait for better opportunities instead of grabbing the first thing that comes along. They mean you can take a job with a lower salary, but a better mission. They mean you can handle an emergency without panic, or change careers, or take time to think. In a world where intelligence is fiercely competitive and everyone is smart, flexibility is one of the few remaining edges. The person who can wait, who is not desperate, who does not have to take what is offered, holds a quiet advantage over everyone living paycheck to paycheck, no matter how brilliant they are. So just save. You do not need a reason. The reason will eventually find you. Point 10. Aim to be reasonable, not perfectly rational. The 10th key point gives you permission to be human. The standard advice in finance assumes you should be coldly rational, a spreadsheet on legs, always optimizing for the mathematically best decision. Housel says forget that. Do not aim to be coldly rational. Aim to be pretty reasonable. Because reasonable is something you can actually stick with for the long run, and in money, sticking with it is everything. He opens with a wild story from medical history. A doctor named Julius Wagner Jauregg discovered in the early 1900s that fevers could help the body fight certain infections, and he even won a Nobel Prize for a treatment that used induced fevers to fight syphilis. Modern science quietly agrees that mild fever can play a real role in fighting infection. And yet, the instant we get a fever, we reach for medicine to break it. Why? Because fevers hurt, and people do not want to hurt. That is it. A treatment that is technically effective but feels unbearable is a treatment people will not follow. A doctor's real job is not just curing disease. It is curing disease within the boundaries of what a patient can reasonably tolerate. Money works exactly the same way. The mathematically optimal investment strategy matters far less than the strategy you can actually sleep with at night. Even the man who literally invented the math agrees. Harry Markowitz won the Nobel Prize for his work on the mathematical trade-off between risk and return, the foundation of modern portfolio theory. When he was asked how he invested his own money in those early years, his answer was disarmingly human. He said he visualized his grief if the stock market went way up and he was not in it, or went way down and he was fully in it. So to minimize his future regret, he simply split his money 50-50 between stocks and bonds. The Nobel Prize winner did not follow his own award-winning formulas. He followed his feelings, because minimizing regret is hard to justify on paper, but easy to justify in real life. Real financial decisions are not made in spreadsheets. They are made at the dinner table, weighing numbers against the fears and hopes of the people you love. House even offers a piece of advice that sounds like heresy in finance. Let yourself love your investments. Investors wear emotionlessness like a badge of honor because it seems rational. But if having no attachment to your strategy makes you more likely to abandon it the moment it struggles, then cold rationality becomes a liability. Few things predict investing success better than simple commitment to a strategy during its lean years. The reasonable investor who loves her slightly imperfect strategy has a real edge over the rational investor who abandons his perfect one, because she will actually stay in the game long enough for compounding to pay. House gives a perfect example from his own life. He and his wife own their house outright, with no mortgage. On paper, this is, in his own words, the worst financial decision they have ever made, because mortgage rates were absurdly cheap, and any rational advisor would say to borrow the cheap money and invest the difference in stocks for higher returns. But he calls it the best money decision they have ever made, because the feeling of independence from owning their home outright, of having no monthly payment hanging over their lives, exceeds any financial gain from leveraging up. Their goal is not to be coldly rational. It is to be psychologically reasonable. And a reasonable strategy you love is more powerful than an optimal one you will abandon. This connects to a related trap, trying to predict the future from history. Investors love studying past data, but House warns that history is mostly the study of surprises, and yet we use it as a map of the future. The most important events in financial history, the Great Depression, World War II, the dot-com bust, the 11th of September, the 2008 housing crash, were all unprecedented outliers that no historical model saw coming. And those few surprise events drove the majority of all outcomes. The further back you look, the more general your takeaways should be. Specific trends, specific trades, and specific market relationships are always evolving and rarely repeat. But the big, human things, how people respond to greed and fear, how they behave under stress, how they react to incentives, those are stable across time. Study history for psychology, not for prophecy. So if the future is full of surprises that history cannot predict, and if we should not trust ourselves to be perfectly rational, what do? That is the bridge to the next point, which may be the most practical risk management idea in the entire book. Point 11. Always leave room for error. The 11th key point is about the most underappreciated force in finance, room for error, often called margin of safety. The idea is simple. The world is too uncertain to bet on everything going exactly as planned, so you must build a buffer into your financial life that lets you survive when things go wrong. And they will go wrong. House illustrates the danger with a story from history's largest battle, Stalingrad, during World War II. A German tank unit sat in reserve outside the city. When tanks were desperately needed at the front, the commanders discovered something shocking. Almost none of the tanks would start. Out of more than 100 tanks, fewer than 20 worked. The reason? During the idle weeks behind the lines, field mice had nested inside the machines and chewed through the insulation covering the electrical wiring. The Germans had the most sophisticated equipment in the world. Yet there they were, defeated by mice. No engineer, no planner, no analyst could ever have predicted that. And that is exactly the point. You can plan for every risk you can imagine, but the biggest danger is always the thing nobody imagines. The correct lesson from being surprised is not that this particular surprise will not happen again. The correct lesson is that the world is, and always will be, surprising. So, how do you protect yourself from risks you cannot even name? You build room for error into everything. Many financial bets fail, not because they were wrong, but because they were mostly right in a situation that required them to be exactly right. Room for error is what lets you be roughly right, instead of needing to be precisely right. It comes in many forms: a frugal budget, a cushion of cash, flexible thinking, a loose timeline, anything that lets you live happily across a wide range of outcomes. And Housel makes a key distinction. This is not the same as being conservative. Conservative means avoiding risk. Margin of safety means raising your odds of success at a given level of risk by making sure you survive long enough to win. Room for error lets you endure, and endurance is what lets you stick around long enough for the low probability, high payoff outcomes, those tail events from earlier, to eventually fall in your favor. The person who keeps enough cash to survive a market crash has an edge over the person who gets wiped out and has to start over, no matter who is smarter. In practice, Housel suggests assuming the future returns you hope for will be lower than history suggests, and saving more than seems necessary, not because you are pessimistic, but because you respect uncertainty. He also avoids what he calls single points of failure, any one thing in your life that, if it breaks, brings everything else down with it. Almost every catastrophic financial story involves one of these, and the most common single point of failure is relying entirely on the next paycheck with no savings between you and disaster. And there is one rule above all the others: never risk ruin. Avoid anything, no matter how attractive the odds, that could wipe you out completely, because no potential gain is worth the risk of losing everything and being knocked out of the game. You can be risk-loving in most of your life and still be ruin-averse. In fact, you must be, because as we learned from compounding, the entire secret is staying in the game. Point 12. Your future self will want different things, and nothing is free. The 12th key point combines two truths that quietly sabotage long-term financial plans. The first is that you, the person making your plans today, will not be the same person living them out tomorrow. The second is that everything worthwhile has a price, even when the price tag is invisible. Start with the first idea. Psychologists call it the end of history illusion. It is the well-documented tendency for people to be keenly aware of how much they have changed in the past, while believing, against all evidence, that they are done changing and will be the same person in the future. Think about it. The career you dreamed of if probably is not the one you would choose today. The lifestyle that sounds perfect right now, whether it is extreme frugality or relentless ambition, may feel like a prison to the person you will be in 20 years. Studies show that adults of all ages dramatically underestimate how much their desires and values will shift. Yet we make decades-long financial decisions, careers, houses, retirement plans, based on the assumption that our current preferences are permanent. So what do you do? House offers two pieces of advice. First, avoid the extreme ends of financial planning. Assuming you will be happy with a very low income forever, or choosing to work endless brutal hours for a very high one, both raise the odds of one day finding yourself filled with regret when your preferences change. Moderation across the board, moderate savings, moderate ambition, moderate free time, keeps your future self's options open. Second, learn to walk away from past commitments that no longer fit who you are. He shares a story about the Nobel Prize-winning psychologist, Daniel Kahneman, who would rewrite entire book chapters from scratch without a backward glance. When asked how he could throw away so much finished work, Kahneman said words his co-author never forgot. "I have no sunk costs." Sunk costs, anchoring today's decisions to past efforts that cannot be refunded, turn our future selves into prisoners of our past selves. The faster you can let go of old goals that no longer fit, the sooner you can get compounding working on the goals that actually matter now. The second half of this point is just as important. Nothing is free. Everything has a price, and the price of big investment returns is not measured in dollars. It is measured in volatility, fear, doubt, and regret, the emotional toll of watching your investments fall and holding on anyway. Here is the framing that changes everything. Market volatility is not a fine, a punishment for doing something wrong. It is a fee, the price of admission for the great long-term returns the market offers. House uses the perfect comparison. A Disneyland ticket costs $100, and in exchange you get an unforgettable day with your kids. Millions of people happily pay it every year, and nobody experiences that $100 as a punishment because it is obvious you are paying a fool for something worth having. Market declines are the same. The drops and crashes along the way are not signs you have made a mistake. They are the admission price of the ride. The trouble is that the market's price tag is not printed anywhere, so many investors try to dodge the fee. They trade in and out, trying to capture the gains without enduring the declines. And like someone sneaking into a theme park without a ticket, they usually end up paying far more in the end, buying high, selling low, and missing the recovery. The investors who succeed are the ones who look at volatility and say, "This is the fee, it is worth paying, and I will keep my seat." Find the price of your financial goals and be willing to pay it. Point 13. Beware of taking cues from people playing a different game. The 13th key point explains one of the most common and least understood mistakes in finance: taking financial advice, or financial cues, from people who are playing a completely different game than you are. Here is the setup. When you ask what a stock is worth, the textbook answer involves earnings and projections. But the honest answer is that a stock is worth whatever someone else will pay for it today, and that depends entirely on which game that person is playing. Consider a hot stock in a bubble. To you, a long-term investor saving for retirement 30 years away, a stock trading at hundreds of times its earnings might look insane. But to a day trader who plans to sell that same stock by the end of the afternoon, the price is almost irrelevant. They just need it to tick up a little before lunch. Both of you are looking at the same price, but you are playing 30-year chess and they are playing 30-minute poker. The price made sense to them, and it would be poison to you. This is how bubbles form and why they do so much damage. Bubbles are not necessarily about people becoming irrationally greedy. They happen when the momentum of short-term traders takes over a market, setting prices that only make sense within their fast game. Then long-term investors, watching prices climb, start taking their cues from these traders, buying assets at prices that are completely disconnected from their own 30-year game. When the short-term players leave, the music stops, and the long-term players who followed them are left holding the losses. Few things matter more in investing than understanding your own time horizon and refusing to be persuaded by the actions of people playing a different game. House makes it concrete with the story of Cisco during the dot-com bubble. In 1999, Cisco's stock rose 300% in a single year to $60 per share, which valued the company at $600 billion. That valuation was Frankly, insane. The economist Burton Malkiel pointed out that Cisco's implied growth rate at that price meant it would become larger than the entire United States economy within 20 years. But the day traders setting that price were not insane. $60 was a perfectly reasonable price for their game, because they planned to sell the stock before the end of the day, when it would probably be a little higher. The disaster came for the long-term investors, who looked at the rising price and thought, wow, maybe these other investors know something I do not, and bought in at $60, planning to hold for decades. Two groups of people, blindly colliding on the same field, playing entirely different games. And when a commentator on television shouts, "You should buy this stock," remember that they have no idea who you are. Are you a teenager trading for fun, an elderly widow on a fixed budget, or a fund manager dressing up the books before the quarter ends? Those three people have completely different priorities. No single price and no single piece of advice can possibly be right for all of them. And here is the twist. This trap reaches far beyond investing. It quietly distorts how you spend, too. So much consumer spending is socially driven, subtly shaped by people you admire. But while you can see how much money other people spend on cars, homes, and vacations, you cannot see their goals, their worries, or their reasons. House gives a personal example. A young lawyer chasing partnership at a prestigious firm may genuinely need expensive suits and a polished appearance. House, a writer who can work in sweatpants, does not. But the lawyer's purchases set Housel's expectations. He ends up spending the money without getting the career payoff, simply because he took his cues from someone playing a different game. It took him years to figure that out. The defense is simple but powerful. House suggests writing down your own money mission statement. It goes something like this. I am a passive investor, optimistic in the world's ability to generate real economic growth over the next 30 years, and confident that growth will accrue to my investments. Once you write that down, something magical happens. Everything unrelated to it, what the market did today, whether a recession hits next year, what some pundit predicts, gets revealed as part of a game you are not playing. So you can simply ignore it, and you are in no danger of being seduced by it. This connects to a related warning about why we believe bad financial ideas in the first place. House says that the more you want something to be true, the more likely you are to believe a story that overestimates its odds. He calls these appealing fictions. When the stakes are high and our control is limited, we grab onto stories that promise certainty, which is why investment forecasts thrive despite a track record barely better than coin flips. We do not follow forecasters because they are accurate. We follow them because facing the truth that no one knows what the market will do next year is too uncomfortable. Everyone has an incomplete view of the world, and we all fill the gaps with comforting narratives. Knowing that about yourself is half the battle. The other half is making sure the narratives you act on are your own, built for your own game. Point 14. The seduction of pessimism. Why optimism is the best bet. The 14th key point answers a puzzle you have probably noticed your whole life. Why does pessimism always sound so smart, while optimism sounds like naive cheerleading? House calls this the seduction of pessimism, and learning to resist it may be one of the most financially valuable skills you can build. Here is the strange asymmetry. Tell someone everything is going to be great, and they will shrug or assume you are selling something. Tell someone they are in danger, and you have their complete attention. Pessimists get quoted in the news, praised for their caution, and treated like sages. Optimists get dismissed. There are deep reasons for this. Evolution wired us to treat threats as more urgent than opportunities, because the ancestors who overreacted to danger survived. Losses genuinely hurt more than equivalent gains feel good. And pessimism sounds intellectually serious, like someone has done the hard analysis, while optimism sounds like a sales pitch. But there is another reason pessimism seduces us, and it is subtle. Setbacks happen fast, while progress happens slowly. A market crash or a disaster unfolds in days and dominates every headline. Growth compounds quietly over decades, too slow to ever be news. Consider the magic of modern medicine. Deaths from heart disease have plummeted over the past 50 years, a quiet improvement that has saved millions of lives. Had that progress reversed overnight, it would be the biggest story in the world. But because it happened gradually, almost no one noticed. Tragedy is an event. Progress is a process. And events make headlines while processes do not. Now look at the actual record. Over roughly 170 years, the American standard of living increased 20-fold. And during that exact same stretch, the country endured civil war, 2 world wars, the Great Depression, more than a dozen recessions and financial panics, deadly pandemics, and stocks losing a third of their value at least 12 times. There was barely a single day in all those decades without a tangible, legitimate reason for pessimism. And yet the long arc bent relentlessly upward. The pessimists were right about the disasters, every one of them. And they still lost, because they underestimated humanity's ability to adapt, solve problems, and grow. This is why Housel says real optimism is not the belief that nothing will go wrong. Real optimism is the belief that the odds are in your favor over time, even though the road will be filled with setbacks and misery along the way. You can, and should, hold both ideas at once. Save like a pessimist, invest like an optimist. Expect short-term chaos, plan for it, keep your room for error, and at the same time stay invested in long-term progress, because betting against human ingenuity has been the losing wager for all of recorded history. Pessimism will always sound smarter. But optimism, the reasonable, patient kind, is the only stance that has ever actually paid. Point 15. Putting it all together, and what the author does with his own money. We arrive at the final point, where Housel gathers every lesson into a short set of principles, and then does something almost no finance author dares to do. He opens his own wallet and shows you exactly what he does with his own money. First, the summary of everything we have covered, in the spirit of his closing chapter. Go out of your way to find humility when things are going right, and forgiveness and compassion when they go wrong, because the world is never as good or as bad as it looks, and luck and risk are always at work. Less ego, more wealth, because saving money is the gap between your ego and your income, and wealth is what you do not see. Manage your money in the way that helps you sleep at night, which is a better universal goal than chasing the highest returns. If you want to be a better investor, the single most powerful thing you can do is increase your time horizon, because time is the most powerful force in compounding. Become okay with a lot of things going wrong, because the tails drive everything, and you can be wrong half the time and still make a fortune. Use money to gain control over your time, because that control is the highest dividend money pays. Be nicer and less flashy, because no one is impressed with your possessions as much as you are. Save, just save, without needing a reason. Define the cost of success, the volatility and fear, and be ready to pay it. Worship room for error. Avoid the extreme ends of financial decisions. Define the game you are playing, and make sure you are not being influenced by people playing a different one. And finally, Respect the mess, because there is no single right answer with money, just the answer that works for you and your family. Then comes the confession. House reveals that his own family's finances are almost embarrassingly simple. He and his wife settled into a comfortable but moderate lifestyle with their entry-level jobs after college, and despite more than a decade of rising incomes, they have essentially kept that same lifestyle ever since. Every raise has gone straight into savings, what they call their independence fund. The part of his financial life he is most proud of is not a brilliant investment. Is it he got the goalpost of lifestyle desires to stop moving at a young age. Their savings rate is high, but they never feel deprived because their appetite for more stuff simply stopped growing. They own their house outright with no mortgage, which he freely admits is the worst financial decision they have ever made on paper and the best money decision they have ever made in real life, because the feeling of independence beats the spreadsheet math. They keep more cash on hand than any advisor would recommend, not for a specific purchase, but so they are never forced to sell investments in a panic or take on debt in an emergency. And his investments? After years inside the finance industry, watching brilliant people try to beat the market, he puts money from every paycheck into plain, low-cost index funds, a mix of United States and international stocks, plus retirement accounts and college funds for the kids. That is it. Effectively, his entire net worth is a house, a checking account, and some index funds. The man who studied every clever strategy in finance chose the simplest one because he concluded that consistently investing in low-cost funds for decades with a high savings rate and a frugal lifestyle is the strategy with the highest odds of success for almost everyone. Not the most exciting, just the most likely to work. And independence, he reminds us, does not require a doctor's income. Independence, at any income level, is driven by your savings rate. That is the entire psychology of money, lived out in one quiet, ordinary, extraordinary plan. So that is The Psychology of Money by Morgan Housel. If you remember just one thing from this entire summary, let it be this. Doing well with money has little to do with how smart you are and everything to do with how you behave. The janitor Ronald Reed beat the Harvard executive not with intelligence, but with patience, humility, and a sense of enough. So control what you can control. Save without needing a reason. Leave room for error, because the world will surprise you. Respect the role of luck, stay humble in good times, and compassionate in bad ones, and never risk what you have and need for what you do not have and do not need. Pay the fee of volatility, instead of trying to dodge it. Play your own game, on your own time horizon, and let no one playing a different game pull you off course. And, above all, give compounding the one ingredient it demands: time. Because in the end, the real prize was never the biggest number in a bank account. It is the ability to wake up every morning and say, I can do whatever I want today. That is the highest dividend money pays. Thanks for watching all the way to the end. If this summary gave you something valuable, you know what to do to support the channel. And until next time, keep the goalposts still and let time do the heavy lifting.